This growth stock is an absolute rocket, and it's still misunderstood by Wall Street. That creates a space for us to find significant value and hopefully make a bit of money. This stock started the year jumping 420% and then crashed over 60% as recently as October 15th, and now we're up nearly 60% from its lows. In full transparency, I first made a video on this stock here in May, around $44 per share, saying I was buying, and that position fell all the way down. Now is down roughly 40%. But the fundamentals were getting better. So I started talking a lot about this one, more and more about how I was buying, the new developments, and here we are now up 57% from those lows. And the question is, what's next for this stock? Is it a buy? Why has it been running? And maybe, is it the Q3 report? And guys, this stock is PLBY Group, ticker PLBY. Let's do it. Today we are talking all things PLBY, also known as Playboy. And before you click away, I know it's a weird one if you haven't heard me discuss it before. Let me just share this with you. They are rebranding the business. They are focusing more on body positivity. 2/3 of their revenue from Playboy.com, which has become a direct-to-consumer merchandise destination, is from people under the age of 34, and they consistently see more than half of their revenue now coming from women. And as a stock, they grew revenues by 67% year over year, which is, not bad. And they have some massive catalysts on the way, but more on those later. We'll start the video with a review of my PLBY thesis, as well as major updates from their most recent quarter, which sent the stock flying over 30% in one day. Then we'll talk about whether or not this stock is a buy and what I'm doing. But first, I'd like to introduce you to the sponsor of today's video, Masterworks, the platform that allows you to invest in one of the best performing alternative asset classes of all time, contemporary art. The art market is on fire, with records recently broken after $2.3 billion worth of art was sold over the course of just 2 weeks. The Wall Street Journal reports art is among the hottest markets on earth, with items selling for 10 times their asking price and the most voracious buying they've seen in years. Rarely do auction houses sell out of every object they have to offer, but that's exactly what just happened. And that's probably because contemporary art has outperformed the S&P 500 by nearly 3x since 1995, yielding an annual return of 13.6% over this period. This means that $100 invested in contemporary art in 1995 would be worth $2,423 today, while the same amount would be just $842 if you invested in the S&P. Although past performance does not guarantee future results, these figures are impressive to say the least. Not only does art outperform, art can also protect against inflation, the biggest boogeyman of today's market. Real assets such as art can help hedge against inflation, making it a great tool to diversify your portfolio. Now, typically, only the ultra-wealthy can invest in this exciting asset class, but with Masterworks, people like you and me can invest in multi-million-dollar paintings from famous artists like Picasso, Andy Warhol, and Banksy. For example, for my first investment, I decided to invest in Basquiat's all-colored cast. Similar Basquiat works have appreciated at 22% per year, and Basquiat also holds the record for the most expensive painting sold by any American artist at $110.5 million. So I simply select the amount of shares I want to own and invest. It's easy as that. And now I can wait for the painting to be sold, or it can sell them on the secondary market just like stocks and crypto. If you want to start investing in fine art with Masterworks, there's usually a waitlist. However, I was able to get you guys a link down below in the description that allows you to skip that waitlist, so make sure to check it out down below if you want to get started with Masterworks right away. Alright, back to PLBY stock. The thesis for this stock can be broken down pretty easily. It's a multi-stage turnaround play, and what management goes for first is the low-hanging fruit. First, they expand their direct-to-consumer or DTC revenues. You see, much of Playboy merchandise sold around the world is licensed, meaning stores sell Playboy merch and Playboy gets maybe 2 to 4% of that sale. Instead, Playboy wants to sell directly to the consumer, hence the name direct-to-consumer, and therefore capture more if not all of that revenue for themselves. Next is licensing deals and partnerships. You see, old management at Playboy negotiated terrible take rates on the previously mentioned licensing deals. They're getting 2 to 4% on licensing when a brand of their stature should easily be getting 7 to 8%, if not more. It might not sound like a big difference, but remember, we're talking about billions of dollars in consumer spend on PLBY, and also, hypothetically, if you go from 2% to 8% take rate, that's a 4x in your take-home revenue. They're also making new licensing partnerships to expand their brand, especially in the gaming category in India and China. Here's a perfect example of a recent partnership that just went live. It's Rummy Online in India. Now, by focusing on this low-hanging fruit, in just 2 years they've gone from 78 million in annual revenue, with China making up 50% of that, to a $280 million in revenue business on a pro forma basis, with less than 15% of their revenues coming from China. And on top of that, Q3 licensing revenue grew 14% year over year despite Rona headwinds. Now next comes the growth phase, and this is where Playboy is laying the foundation for an incredible new ecosystem and business model, and it's also where you'll find most of their new initiatives, including Centerfold. We'll revisit this in a second, but let's paint a picture of their entire ecosystem first. Aside from Centerfold, you have their sexual wellness products, lingerie lines, and merchandise, all direct to consumer. You've got gaming, clubs, casinos, a rumored new whiskey, and potential for private label products as well. In addition, we could see them rolling out beauty and grooming products, and they've also mentioned eventual plans for a THC-based cannabis product line. But no definitive plans on neither of those yet, as far as I know. And also the key to all of this, what makes it all make sense and why it's such an incredible ecosystem opportunity, Rabbitars. Well, not just Rabbitar NFTs, but more accurately, exclusive membership experiences. The first of which seems to come in the form of Centerfold and Rabbitar NFTs. But before we jump into the huge updates on those two, I should first mention that Playboy's DTC expansion is going very well. Their transformation of Playboy.com to an e-commerce and merchandise destination has led to the site generating more e-commerce revenue in the month of September alone than in all of 2020. Average order volume is rising, and customers with higher spend tend to return quite frequently. In regard to their other DTC brands, management says they're learning from the high margin practices of Honey Birdette, and that could trickle into the margins of Yandy and Lovers as they continue to learn from one another. And they continue to also connect, I'm saying continue a lot, they continue to also connect the back ends of these businesses to create that unified DTC infrastructure that they so desperately need. And now it's time for some more exciting news. Centerfold should be launching in early December, which is way ahead of schedule than when they initially announced this project. They describe it as a home for the world's top creators to expand their community's e-commerce businesses. And that is so important because it tells us that Centerfold will do more than OnlyFans. That's what it's been mostly compared to. This screenshot is from their March 2021 investor presentation, and it says they hope to develop Playmate's lingerie franchise. Well, wouldn't it be perfect if Centerfold creators could just partner with Playboy to launch their own lingerie lines and sexual wellness products related to their personal brand? Well, yeah. They can. Playboy plans to allow creators to tap into their resources like merch design, production and distribution capabilities, collabs with the brands they own, NFT launches, blockchain tools, and much more. And I think this is going to be a huge reason for OnlyFans creators to either leave that platform for Centerfold or at least give Centerfold a try. It's giving you so many more business opportunities that are much more readily accessible and easy to deploy for yourself. And some people were worried about whether or not Centerfold could get creators on board, but I wouldn't be too concerned. Their anticipated founding team, or the initial creators, artists, and musicians who they expect to sign onto the platform once it launches, have a collective 300 million social media followers. And they already generate hundreds of millions of dollars in volume in the creator economy. And that's because the people signing on are huge music stars, former Playmates, adult stars, artists, actors, celebrities, and other influencers. So yes, it's an OnlyFans competitor, but as you can tell by who's signing up, it's also going to be a lot more than that. I could imagine something pretty crazy, but also realistic, like a Centerfold show, where several Centerfold musicians come together to host an exclusive live show, but it's also broadcasted virtually to anyone who holds their NFTs maybe. And those NFTs, perhaps Playboy gets a 2 to 3% royalty every time those are transacted, and the artist gets the remaining 8 to 7%. These scenarios might seem far-fetched, but I'm just trying to give you ideas of where this could go, because so far we've speculated a lot with this stock, and turns out that's what ends up happening and being executed on by management, so we'll see if we can keep that streak going. As far as their Rabbitar NFTs go, Playboy has continued to emphasize the long-term nature of this project. It is not just a cash grab, rather it's the foundation of a marketing flywheel for their even bigger opportunity to create a cohesive and scalable ecosystem of recurring revenue-based Playboy membership offerings. So far in Q4, they've generated over 10 million in revenue from NFTs since their launch of the Playboy Rabbitars, and that's about on par with what I projected in this channel before. And yes, they do hold Ethereum on their balance sheet, but it's still sub 10% of their cash position. So what do the numbers look like? Is it still a buy, and what what am I doing? I've kind of come to realize that it's sort of silly to try and dig deep into these quarterly numbers with Playboy, especially this one, because next quarter, this business is going to look completely different with the launch of Centerfold, more execution on the Rabbitars project, and probably other things added to the revenue mix as well. With a company innovating and adding products this quickly, it's almost better to pay attention to see whether or not they're executing well on these initiatives rather than trying to figure out which line item caused that 2% change in margin. So I'll just try and keep it high level. The Playboy CFO basically told us that their 2025 revenue target is way too low without actually telling us it was way too low. You see, he said on their Q2 call, they raised their 2025 revenue guidance to $600 million in annual revenue, doubling the outlook they gave when they first went public in February. Now, this target did not include any revenue from upcoming initiatives such as Centerfold, NFTs, and membership. He went on to say he won't give guidance for that today, but they believe that if they're successful in their launch, the long-term recurring revenue opportunity on Centerfold alone could be larger than their entire consumer products business. And if you were subscribed and saw my video comparing Centerfold to OnlyFans financials, you would know this already. We've been speculating this since September, so make sure to subscribe. Anyways, it's just nice to hear from the CFO himself that this opportunity is as big as we thought it was. And if 2025 is 4 years from now, that means Centerfold at that point would be 4 years into its existence. So if their 2025 revenue target of $600 million doesn't include Centerfold, which the CFO said could be bigger than their entire consumer products business, and will be 4 years old at that point, well, you better get that target up. And in my opinion, that piece of information right there is probably what caused that 30% jump the day after earnings. Now, ultimately, a lot of this investment rides on execution. You're really investing in management, and I've been holding this stock for about 6 months now, and in that short time frame, management has already earned a lot of my respect. And what's even better is knowing the CEO has recurring revenue on his mind. He says here that he loves businesses that focus on recurring revenues, so expect a lot of moves to be made that put PLBY in that position. And you know who else loves recurring revenues? Wall Street. So in terms of what I am doing next, again, PLBY is a tough one to model and value right now because they're pretty much building a new business starting 2020. And therefore, a lot of their new major initiatives have either just launched or haven't launched yet. So again, sticking to those higher level ratios and doing some napkin math, I would say that 5 times the next 12 months EV to revenue where it's at right now is pretty fair. You know, you have to understand this is no longer an apparel company. It's starting to almost become a tech stock, in my opinion. Maybe that's a bit of a stretch for now, but we'll see. And yeah, next 12 months EV to EBITDA does look pretty expensive right now, but wait until you see those margins roll in from Centerfold and watch that EBITDA as a denominator shoot upward. In my opinion, I wouldn't even talk about profitability metrics until Centerfold is at least a year in and we get more visibility on its numbers. So all in all, it's a bit riskier and obviously a bit more expensive than it was when it was trading the low 20s. However, I still think this is an all right place to get into Playboy if you're in it until 2025 or longer. I don't think it's ridiculously expensive right now. In fact, I think the valuation is still okay. However, I would say that again, it's a lot of executional risk, whether or not management can pull this off. So if you're looking for a spec stock or maybe a stock that fits like a 3 to 5% position in your portfolio, depending on your diversification, maybe this is the stock for you. If we see any significant weakness in the stock, I will likely be adding as long as the fundamentals and execution is going well. And I'm not much of a price targets guy. I usually don't set price targets or anything like that, but I will, just for the fun of it, go on record and say that by 2025, will be at $140 per share. That would be about a 4x from today's prices, so check back here in 4 years and see what happens. And you better not buy just because I said that. You better do your own due diligence. This is not financial advice, never was, never has been, and never will be, but I figured it'd be fun to throw out a price target. So yeah, thank you to Masterworks for sponsoring this video. I hope you guys found it valuable, and subscribe.